Welcome to Fed Watching for the week of January 21st through 25th. And generally, pretty uneventful week, although it seems like we got the end of the government shutdown, and I got a couple of really good links for you coming at the end. So let's get right into the dailies. It's Monday, January 22nd, and the market's down about 1.5% on, you guessed it, more China talks, more trade talks breaking down on more talk of federal government shutdown, and this one was the actual surprise 3-year low on existing home sales. So, why would we get that? A lot of people not getting a paycheck, harsh winter. Maybe people are just starting to figure out what the cap on the mortgage deduction, the property tax deduction actually does to the economics of it. I don't know. It's a good question. Seems like the real reason to move down was that home sales number, although we did open down and that number didn't come out until a little bit after the open. But a little downer day to start the week, and we'll see what we get next. It's Tuesday, and we're back up here instead of being over there, and a little bit of a good day for the biggest stocks. So Dow was up a little more than 0.5%. S&P 500 up a smidge. Russell 2000 down a tiny little bit. Not so much news, not so much movement. Nothing really happened. It's Thursday, not a lot of action. S&P 500 basically flat. Smaller stocks up just a bit, 0.7%. So opposite of what we had just before. Not a big day, no real news. We'll see tomorrow a lot of the numbers that we would normally get, we won't get because of the shutdown. It does seem like there were some attempts to make some steps towards ending the shutdown. It seems like Trump might be running out of an appetite, or somebody on the Republican side might be running out of an appetite for this. It seems like there's a lot of heat coming down all of a sudden. So we'll see what we get tomorrow. It's Friday, another up day, another up week, and we did get an end to the shutdown, at least temporarily. I haven't had a chance to read any of the details yet on exactly what happened, if everybody's coming back to work or if they're just paying the furloughed workers, or what exactly it is. But it sounds like for at least the next month, things are sorted and they're going to try to figure things out. And there you have it. Very uneventful. Most of the indices ended up just a tiny little bit. S&P 500, kind of the lone outlier, ended down 0.2%. So basically flat on the Dow, basically flat on the Russell, basically flat on the NASDAQ. EFI and emerging markets up a little bit more than that, and then 10-year treasuries down just a smidge. There was barely any news other than obviously the shutdown having a temporary cease, a temporary little deal. It seems like the market will be happy if that gets settled away, but it didn't seem to move things too much either way, to be totally honest. So let's get into the econ recap. Not a lot on the econ side either. Jobless claims were low, as they have been for a long time now, but they continue to be low, under 200,000. And then PMI numbers came in about where expected, so that's good, that's normal. Existing home sales are pretty weak, and I wonder, my personal hypothesis is people are starting to figure out the tax ramifications of the 2017 tax bill that generally hurt homeowners in a couple of different ways. And then three numbers that we usually like to see: durable goods orders, capital equipment orders, and new home sales. We didn't get any of those because of the shutdown. So we should get them either the next time they normally come up, or maybe they'll go back and calculate them retroactively. I don't know. But we didn't get those numbers, so not a lot of action. Two bits of reading for you. One, if you want to do a big deep dive, and one, if you just want to have an enjoyable read. So the enjoyable read is from Ben Carlson, and he gives a list of things that he learned from Jack Bogle, who just passed away at 89. He was basically the founder of the Vanguard that we all know today. And the long-term read is called Capitalists in the 21st Century. So you can tell, addressing a lot of Piketty type thoughts. And it's Matthew Smith, Danny Yeagan, Owen Zadar, and Eric Zwick. And it's a really long paper, but it's full of a bunch of great information. And what they're looking at is who is really earning most of the money. Is it the idle rich, or is it the working rich? Is it a bunch of people that have accumulated capital, or is it a bunch of people that are, still working and adding value? And I had some really neat ways that they went to tease it out of the data. But the biggest one was they were looking at what happens to companies when one of the key managers, the key owners, retires or dies. And the answer was most of the value of those firms disappeared. I think it was 3/4 on average. So most of the value of the firms was coming from these key employees, these business owners. And they're at the top of the income distribution, but those business profits aren't excess profits that they're earning because they have capital. They're excess profits that they're earning because of the human capital. So really good paper. If you're into inequality economics, definitely you got to read it. That's it for this week's episode of Fed Watching. See you next week.